Greetings viewers, I am Dr. Isha Raval and today we will be deliberating on a very interesting series, Security Analysis and Investment Management. Before we proceed, let me just introduce myself. I am working in the capacity of Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies, Technical Campus, Delhi. So, in this specific session today, we will be discussing what exactly are capital markets, what are their features, what is the pivotal role played by them, why are they so important for the growth of an economy. In fact, why should one have capital market in a specific economy? Then, what are the different types of assets, different types of instruments which are traded in the capital markets. So here we go. To begin with, let's discuss what are capital markets. As the word itself suggests, capital market. It is a long-term market with very high amount of risk and similar is the return. People who invest in capital markets are the ones who are risk lovers, who are not risk-averse investors. In fact, they like to take risk in anticipation of getting a very high return. A capital market is a market for borrowing as well as lending of long-term finance, that is, for a period which is greater than 1 year. It is an organized financial market where savings and investments, they both are channelized between the one who has sufficient money and the one who is in dire need of money. So at one point we have somebody who has surplus funds and the other is in search of funds. So a capital market is a place where these two entities easily get a platform to exchange their funds. The one who is giving the fund is in need of return and the one who is taking the funds or is either giving in form of capital or in form of debt is actually trying to get these funds to generate further returns on this amount. A capital market actually serves as the link, as we said, between the savers and the investors. This market involves trading of long-term financial securities. When I say long-term financial securities, all those financial assets which an individual holds for a period greater than 1 year are termed as long-term financial securities, and these securities are issued either for raising or investing of long-term finance. Let us understand what we understood what are the capital markets, but what is the purpose? What are the different functions which it offers in an economy? So as I just said, that it is actually providing a link between the savers in one hand and the investors on the other. It actually serves as an intermediary between the people having excess funds and the ones who are in need of funds. It channels the idle lying resources, somebody having surplus money, somebody having idle cash, to these resources. Now they are channeled to more productive sources where it can generate income and can also increase the productivity. It mobilizes people's savings by directing and guiding them for productive investment. When I say productive investment, as an investor, you may have multiple investment opportunities. But of course, the return which you get on these opportunities, these investments which you make would vary from investment, the first asset to the second asset to the third asset. The purpose of having a capital market in an economy is to actually provide the link, the platform, the place where these idle lying resources can generate productive returns, where they can get actually higher amount of return. These investments, they provide regular income as well as growth to the investors. Another important function of a capital market is capital formation. Capital formation is very important in an economy. The capital market has an efficient role in capital formation in the economy. It not only fulfills but also caters to the financial needs of different sectors of the economy by providing them with sufficient funds timely. There are two important things. One is availability of sufficient funds and second is timely availability of these funds. Suppose there is a business or unit and the business unit wants to start up a new project. They may be interested in doing some sort of geographical diversification, or they may be interested in starting a new product, in manufacturing a new product. So the first place where they go is the capital market so that they can raise sufficient funds to put into the relevant project. Therefore, the idle lying funds which are available with the investors, these funds they get transferred from these idle lying resources to more productive and development resources. Why do we say more productive and development sources? Why? Because the project which the organization is starting, the company may be starting a new product line wherein the return would be really exponential, and as an investor you may not be able to get it. So when these funds they get transferred from the idle place to the productive place, the returns are huge. Therefore, the capital market mobilizes the savings of people through investments and lends that money for large development projects in the economy. This way, it fulfills the overall fund requirement and helps in adding to the existing stock of capital in the economy. Another important function of capital market is to regulate the security prices. It helps in regulating the stable and systematic prices of securities. The capital market continuously monitors the trading of securities. It keeps an eye over whole processes and avoids any speculative trading. This actually helps in the security prices stabilization in the economy. Another important function of a capital market is the provision of investment avenues. Now, when we have a capital market in place, it provides multiple investment opportunities, and that is different long-term investment avenues to the investors looking for long-term investments. Capital market, the deal in trading of long-term securities, thereby it assists in raising and lending money for longer duration. It provides and offers good returns to the people for investing their surplus funds. People are in fact encouraged to invest their hard-earned money, their funds, the idle lying resources to earn regular income in the form of return. One very important aspect of capital market is to promote the economic growth and develop the entire economy. The capital markets, they help in economic growth and development in the country, as the capital market speeds up the economic growth rate in the country by providing funds among different sectors of the economy continuously. When there is an economy which is still in the developing stage, where the funds are required in humongous amount, these funds are actually provided by these investors who take the risks to put up their money in such challenging projects, to put their funds in a market where the returns are expected to be very, very high. And that is why when these funds are put into the economy, it leads to economic growth and development. These markets, they provide funds for the large infrastructural development, because when an economy is developing, an economy is growing, there it requires huge amounts of funds for infrastructure development, for different projects, and the long-term finance requirement of various business houses are met by the capital market. Therefore, it improves the productivity of the economy by improving infrastructure facilities as well as generation of employment. Because when a new infrastructure is coming up, for example, if there is a bridge which is getting built, people will certainly get employment. If there is an industry which is being set up, there people certainly will get employment. So there are two aspects. One is the infrastructural development, and the second is the generation of employment, which ultimately leads to the economic growth and development of the economy. When we have capital markets, they help us in minimizing the transaction cost and time. Why? Because when suppose there is a person who's in a distant area, he is or when she tries to invest the funds maybe in the stock market, but there is no platform, when there is no regulated capital market, then he will have to look for somebody who can buy his or her shares. Then in that case, the transaction cost would be too high because he will have to travel to the place where the person is available, the buyer is available. But when we have a fully regulated capital market, the trading is facilitated of all the long-term securities. It reduces the overall cost and time involved in the whole trading process. The entire trading process is conducted electronically, and that is through the automated systems. So systems which are sacrosanct, which are tested beforehand, as well as the programs which are run already, and this entire thing actually speeds up the entire buying and selling experience, and there is minimization of time. Say for example, if I want to sell a share which is lying in my demat account, I can do it at the click of a button. I will just log into my terminal and I will be able to sell the share which I hold in my demat account. Thereby, without even traveling, without even going to any place, I will be able to enter into any sort of buying or selling process. Therefore, it helps in the reduction of transaction cost and also helps us in saving time. Then, when we have capital markets, there is continuous availability of funds. Why? Because whenever you see the capital markets, you will always find there are buyers at one hand and then there are sellers at the other. And both of them want to strike a transaction. The buyers are looking for the opportunities to invest. The sellers are looking to sell the products, the commodities, the assets which they hold. Therefore, the capital market ensures the sufficient availability of funds in the economy. It continuously provides long-term investment avenues to investors. And the liquidity is pretty high. Why? Because there are buyers as well as sellers who are continuously available in the market. It always circulates funds among the different sectors of society, thereby ensuring adequate availability of funds. Having understood the various functions which are played, the vital role which is played by capital markets, let us understand that what are the different types of markets by maturity of claim. When we say maturity of claim, we are trying to say what is the duration within which that financial asset, that particular stock or commodity or a debenture is getting matured. So there are two basic types of instruments. The first is a debt instrument and the second is a common stock or preferred stock. A debt instrument, as the name itself suggests, refers to any sort of loan which is provided because there is an element of debt here. And the second type is common stock or a preferred stock, which is giving you the right to vote, which is giving you the ownership. Having said that, if we look at the debt instruments, there are two categories of debt instruments. The first one is with a maturity period of 1 year or a little less than 1 year. If we are dealing with such sort of instruments, they are dealt with in the money market. There are many money market instruments like we have call money, then we have treasury bills, there are certificate of deposits or commercial papers for that matter. All these instruments, they are a part of money market. But today we are discussing about all the capital market instruments. So the bonds, the debt instruments, the government securities with a maturity period greater than 1 year are dealt with, are traded in the capital markets. Apart from that, we have common equity shares, the ordinary equity shares, the preference shares, the bonus shares, the rights issue which is made, the derivatives, all of this is a part of capital market. Now, as I just said, that there are three types of instruments which are dealt with in the capital market. Let us understand the first one, which is equity instruments. So equity instruments, the examples can be equity shares and preference shares. The debt instruments include government, corporate bonds and debentures. And the third category of instrument, which is a part of capital market, is the derivative instruments, a sector which is really liked by a lot of people these days. And the types of instruments dealt there are forwards, futures, options and swaps. The first instrument, as I just said, is equity share. So let us understand what are equity shares. These are the shares which are providing long-term financing sources for any company. These shares are issued to the general public and are non-redeemable in nature. When I say non-redeemable, that means there is no maturity period. Whenever there is an organization, whenever a company is set, it is established, the lifespan of this company is actually infinite. The management may come, it may go. But when we say an establishment, a company, it is in existence forever until and unless it goes into liquidation. That is why when you buy the share of a particular company, they are considered to be non-redeemable. Why? Because you are the owner of this organization. Certainly you can sell these shares in the secondary market, in the capital market, but there is no maturity period which is attached to the equity shares. Investors in such shares, they hold the right to vote. They have the power to vote, they can share the profits, and they can also claim assets of a company. The claim is made just because they are the owners of the company. Now, under equity shares, there are different types. The first one is ordinary equity share. Such shares are issued by a company to procure funds to meet long-term expenses borne by a business. They have ownership rights, as I just said, wherein the investor gains exposure to various management segments involved in running operations. Management segments, that means you have a right to vote, you have a right to take decision, you can intervene in the working of the organization if you have a substantial stake in that specific organization. An individual possessing a large number of these types of equity shares have substantial voting rights and can actually decide what project to opt for, can attend the annual general meeting of the company, and can have a say in taking major decisions of the organization. The second type of equity share is preference equity share. The name itself suggests preference. That means a person who is investing in preference equity shares will have a preference over the other ordinary equity shareholders. They are generally issued to an investor as a guarantee of the payment of cumulative dividend before the returns are distributed among ordinary shareholders. That means whenever the company announces a dividend, it is the preference equity shareholders who have a right, who will be given the preference to get these dividends funds before it is actually distributed to the ordinary equity shares. But with this clause, with this preference, there is an issue, because preference shareholders, they do not have any associated voting right or any membership right. The classification among preference shares can also be made depending upon whether it is participating or in the non-participating capacity. That means if an investor purchases participating preference shares, he or she is entitled to the stipulated amount of profit as well as the bonus returns depending upon the performance of a company during a particular financial year. Whereas the owners of non-participative equity shares, they are not eligible for such benefits. The third category of ordinary equity shares are the bonus shares. So bonus, the word says something additional, something more. These types of equity shares are issued out of the retained earnings of a business, wherein the profits are distributed among investors in the form of an additional stake in a company. That means these shares are issued to the existing shareholders. Contrary to other type of equity instruments, these bonus shares, they do not increase the total market capitalization value of a company. It just represents capitalization of excess funds generated from the production. So whatever is the additional profit, out of that profit, instead of giving the dividend, the company issues the bonus shares, so that the existing equity shareholding pattern, the division, it remains the same. The fourth category of equity share is the rights share. These shares are issued by a company to premium investors at a discounted price as an invitation to increase their stake in the respective business. A firm only sells shares to rights for a stipulated time to raise the required finance to meet its expenditures incurred. That means the company gives its existing shareholders the right to purchase the additional shares which it is actually issuing. Having said this, the four categories, the discussion is done of all the four categories, the types of equity shares. Let us have a look at what are the features of equity shares. So most type of equity shares, they include voting rights to an investor. They allow him or her to choose individual responsibility to run the business. Electing efficient managers allows a company to increase its annual turnover, and they can even actually increase the investors' average dividend income. So most of the equity shares, they have a voting right, have they have the authority to take decisions. The equity shareholders are also eligible to earn additional profits generated by a company in a fiscal year. How can they get the additional profit? Because when the company gets huge amount of money, when the returns are pretty high, the way of distribution is that when the company gets huge amount as profit, so out of that profit, first the debenture holders are given their interest. Once this interest payment is made, the company has surplus funds. Out of these surplus funds, it can decide to pay some amount to the preference shareholders. Now, once the preference shareholders are given their due credit, their due dividend, whatever is left, that is actually the money which belongs to the equity shareholders. Now, it is when the management decides that instead of distributing this amount as dividend, they want to put it back into the business. They want to plow back their profits because they know that the return is much higher. In that case, the equity shareholders may not get the dividend. But if the management decides, if in the AGM it is decided that the equity shareholders will get a better amount of dividend, a higher rate of dividend, then it is the equity shareholders whose total wealth increases. Because somebody who is having a considerable amount of shares, considerable number of shares in the company, they are likely to build an empire with the help of equity shares. We have seen companies like Infosys. People have actually, from rags to riches, people who have invested their money in Infosys when the first share was issued, and today if we look at their wealth, it is too much, it is huge. People even plan, they say that let's put our money in one good stock today and we are going to look at the price of it after 10 years or after 18 years when we need it for arranging for the education of our child, or maybe for the marriage of our child, for our daughter. So that's the perspective. People who invest funds in the capital markets or in equity shares, they do it with an aspect that they are going to get the ownership of this company, and they strongly believe in the fundamentals of the company, and they say that we are going to stay allocated to this company, dedicated to this company, and stay invested into this company because the returns will be huge. They kind of become the owners of this organization. Okay. Another feature is that even though equity shares, they are not repaid until a business closes down. That means they are non-redeemable. There is no maturity period. But equity shares already issued can certainly be traded in the secondary capital market, that is the stock market. Therefore, the investors, they can actually withdraw the funds from a company upon their discretion. So today, if I hold, say, 1 million shares of a particular company, then in that case, if I decide today I want to sell it, I can actually sell it today because I just need to log into my terminal and sell my shares. This ensures massive wealth creation through capital appreciation of such shares. At one hand, I have the liquidity. At the other hand, I know that if I stay invested in the long run, my capital is going to get appreciated. So what are the benefits of investing in equity shares? One is that it leads to higher amount of return. Capital appreciation, return first in the form of a dividend, and second is the wealth creation, because if you are in for the long run, then your capital is certainly likely to appreciate. Another benefit is that it provides a hedge against inflation. We all understand that the markets, the interest rates in the economy, they keep going up and down, and they are always in tandem with the inflation rate in the economy. So if the inflation is high, the interest rates go up. If the inflation is less, the interest rates go down. But people, the money which you are investing in the equity shares, it actually multiplies many folds, higher, much higher than the rate of erosion of an individual's purchasing power due to inflation. So someone who is investing in a savings bank account can earn a maximum interest of 2.5% to 3% In FD, maximum 6% or 7%. But if you stay invested in the capital market, it is actually covering you. It is providing you a hedge against the inflation. The next benefit of staying in equity shares is portfolio diversification. So as an individual investor, if you have a low risk appetite, you can opt for securities which are safer. Maybe you can opt for blue chip organizations. People who have high risk appetite can opt for such securities, such stocks where they may not be very prominent, they may not be having an excellent track record, but because you have faith in the organization, you've studied the fundamentals of the organization, you can even invest in small cap or mid cap. So it completely depends on your risk appetite, and you can even invest in multiple securities at the same time. You can create a portfolio of companies belonging to 10 different sectors. For that matter, even an investor can invest in the index. This helps in diversification, and then the fall in the price of one security can be covered by the rise in the price of the other security. But when we say benefits, certainly there are a few risks also which are associated to equity market, the stock investments. The first and the most important one is that the market is very volatile in nature. Today, the market opens at a very high, and tomorrow you can see that there is a lower circuit because there is some bad news coming into the market, because we get global cues. So if the US market closes at a very low point a day before in the night when we all are sleeping, in India, the markets will always be in red. They will be this. That is why there are major fluctuations. Any event taking place in any major part of the world, that has an impact on the stock market. That is why we say that when you are investing your funds in the equity market, the risk is pretty high because of the volatility in the market. Now, this actually lowers the share of profit, because when the markets are volatile, the companies are likely to repay their liabilities first, and then they cannot actually make the payment to the equity shareholders. The other is market fluctuations. As I said, very, very high. The fluctuations take place very frequently. And the equity investments, they actually tend to rise in value over time. But if the funds are kept locked in for an extended period, it may so happen that the wealth may be eroded, because if you make a wrong choice once, the wealth can get eroded. So these are majorly the risks associated with stock market investments, the equity investments. Thank you so much for your patient listening. Thank you.